Hi guys, good morning. Welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. A happy morning. Really, after yesterday's clash between India and Pakistan, of course, Virat Kohli rose up to the occasion. In fact, did score a very, scintillating century which powered India to a victory against their arch rivals. Of course, the king really came back to form, when it was much needed. Started, with a 20-odd run score when it comes to Bangladesh. But yesterday, that was the occasion when he rose to and he, really smashed a century and silenced all his critics, and of course a very, very important victory coming in the Champions Trophy. Also, he crossed the milestone of 14,000 ODI runs, second batsman to do it after Sachin Tendulkar. Of course, India has of course jumped to the top spot in their group after the victory, but they still need a third victory to confirm their semis berth without relying on other results. So yes, a very good week. Way to start the week rather, but whether or not it translates into a good week for the market, that's something that we'll be watching out for, given the fact that Friday, any signs of recovery that we saw in the broad end of the markets completely fizzled out. And on the headline indices, we managed to close another week of losses, although the broad end of the markets managed to outperform given the 2-3 sessions of gains that they saw last week. This morning, global cues aren't looking all that upbeat. We have of course taken out that 22,800 mark, and we are headed downwards, but how much downside, we will try and get our technical experts to answer that question. Lots of stocks in focus, we'll be focusing in on them as well. But before we move any further, let's quickly take a look at the top headlines. Weak consumer sentiment and economic data spark a sell-off on Wall Street on Friday. Tech stocks were the worst hit as the Nasdaq corrected over 2% to record its worst weekly performance since November. The Dow and the S&P 500 also slipped over 1%. Asian markets opened with cuts after a weak handover from Wall Street. The GIFT Nifty is also suggesting a weak start for the Indian market. The Japanese market are shut on account of a holiday today. Gold prices eased from record levels on Friday but gained for the 8th straight week as trade and economic uncertainties persist. Brent corrects over 2.5% on easing geopolitical tensions in West Asia and between Russia and the United States. And the National Stock Exchange announces key changes to the Nifty 50. Zomato and Jio Financial will enter the index from the 28th of March at the expense of BPCL and Britannia Industries. And India defeated Pakistan by 6 wickets in the Group A match of the ICC Champions Trophy. Virat Kohli roars back to form with a classy century. His 51st ODI century and 82nd ton in international cricket has effectively silenced any lingering concerns about his form. All right, in talking about Friday's session, markets failed to hold on to early gains. In fact, the mid-cap index snapped a 2-day relief rally. The Nifty, in fact, broke that floor of 22,800 mark for the first time since June 5 on a closing basis. Till now, whatever sell-off we've seen, we did manage to defend that 22,800 on the downside, but that was violated on a closing basis on Friday. Ex-Nifty metal, all sectoral indices ended in the red. The Nifty FMCG pack, in fact, has been down for a 15th straight session, and autos, that sector has also been underperforming. It was the worst performing index, dragged by M&M, which nearly saw a 7% plunge, its sharpest fall in the last 7 months. Taking a look at some of the other cues, then I want to just see the Nifty put call ratio that slipped from 0.9 to even further below that level. In fact, the advance decline ratio on Friday was 1:2. PCR was at 0.82 vis-a-vis 0.9. There is a new entrant in the ban list, FNO ban list, Chambal Fertilizer, and Manappuram Finance continues to be in the futures and option ban for today. The foreign investor community continues to sell. 3,450 crore worth of stocks were sold in the cash market. On the flip side, DIIs continue to buy 2,800 crore rupees worth of stocks bought in the cash market. But on that note, let me bring on board our technical guest for today. Joining me, Sudeep Shah, Head of Technical and Derivative Research at SBI Securities. Sudeep, great to be chatting with you this morning. If you're a cricket fan, I'm sure you are in high spirits. But if you look at the screens, not quite, given the fact that we've broken below that 22,800 mark. Would you expect the 22,800 mark to be, a floor on the higher side now? Do you think the support has now shifted to being the resistance zone, 22,800 on Nifty?
Yeah, good morning, Nandita. A diehard cricket fan, and it was a fantastic day yesterday. And I hope someone turns out to be a Virat Kohli today also for our markets also, so that at least whatever the gap down opening has been should be that Virat Kohli of the market helps the markets to recover. But just coming back to the market levels, I feel 22,550, 22,580 zone now becomes an important support. We are opening very close to that zone. And in the last 1 week now, 330-point range, that was the tightest range since December. So a range breakdown with such bad global cues, I feel one should be a bit cautious. 22,550, 22,530 zone, a very important support below which if Nifty slips 22,300, 22,250 cannot be ruled out. So a kind of caution is required, I feel, say at least in the first half. And if we see any bout of recovery, say markets at least reaching that 22,750, 22,800 marks and trying to settle there, then yes, this could be a new range, 22,550, 22,500 and 22,900 on the upside. So 22,530, 22,550 will be the all important level that I would be eyeing for post the opening today.
And in 22,580, you're saying, so below 22,600, that's the next key support zone on the below that, we shut shop below that level. In fact, 48,600 is where we shut shop on the Nifty Bank Index. Would you keep 49,200 as the resistance zone on the Nifty Bank Index now?
Yeah, very well. See, 48,950 to 49,100, this 150-point zone will be a critical resistance on the upside. Above 49,100 only, I feel now a bigger move could be witnessed. But having said that, see, if you compare Bank Nifty and Nifty, and if you put both of them on the ratio charts, Bank Nifty is still outperforming Nifty by a margin in the last few weeks. So my sense is that the first signs of recovery would be visible in Bank Nifty only, and with the Bank Nifty expiry also in this week, the monthly expiry, there could be some kind of volatility also there. So if at all there has to be a recovery in the markets, I feel that would be led by Bank Nifty, because IT index also is showing some signs of slowing down or some kind of distribution patterns are visible there. So Bank Nifty is what I feel should be watched as the first sign from a recovery perspective.
All right, just about 40 odd seconds to go for the market to open. But Nifty Pharma is another pocket that has been in focus. It has been underperforming. In fact, if you look at the last 5-day performance, this sector is also down somewhere around 3% or thereabouts. Your thoughts? Any stocks that stand out?
See, in Nifty Pharma, if you see, it's a consolidation breakdown that has been witnessed. The index was holding 22,700, 22,750 in the last 3 weeks. And there has been two consolidation breakdowns. One in the first week of February, where it broke the entire January month's consolidation range. And now in the last week, where even the February consolidation zone was broken. So my sense is that from the current levels, 20,500 will act as a resistance, and that needs to be crossed from a reversal perspective.
Sure. As we speak, we're getting the first ticks, and it's not a pretty picture. It's a triple-digit cut on the index. In fact, we are very close to that 22,600 support zone. In fact, 22,580. That's what Sudeep pointed out. coming very close to that now. 22,650 is where we are at. It's a triple digit 150 point cut on the index. Sensex as well, holding on to that 74,900 mark as we speak. It's a 0.5% cut coming in there as well. The mid cap index, whatever relief rally we saw over a couple of sessions last week, fizzled out on Friday, and it's now sinking even deeper, in the red. The mid cap index is down in excess of 1%. The advance decline ratio at the start of the day not looking good. It's 1:4. That's the NSE advance decline ratio. 398 advances to 1700 declines. So yes, the sell-off is only resuming. Whatever sell-on bounce or buy-on dip rather that we saw last week, that texture has completely changed. Let's take a look at the sectors then that are taking the lead on the downside. I want to quickly see. First of all, the bank Nifty, I want to see what this index is doing. It's down almost 0.8%. 360 point cut coming in there. 48,600 is where we are at when it comes to the Nifty bank index. Just want to see what the other sectors are doing. The auto pack, mind you, it was the worst performing sector on Friday, down 0.5%. You have the IT pack, 1%, in excess of 1% lower on the IT pack. Metals, that pocket was shining bright amid Friday's sell-off, but even that sector has kind of joined this sell-off. 1% cut on the Nifty metal pack as well. The PSU banking lot is also down 1%, realty down 1%, oil and gas 1%. So yes, no gainer. All the sectors are trading in the red. Looking at the India VIX, it has jumped 7%, 15.55. That's where the India VIX index is at the current juncture. Let's also take at some of the individual movers then, which is the stock that is taking the lead when it comes to the sell-off. First of all, would like to point out there are only a handful of gainers, just about 4 of them to be specific. Dr. Reddy's, Sun Pharma, these are the 2. Aside of that, you have Nestle and Tata Consumer. These are the only gainers as we speak. And if you look at the laggards, ONGC, that's dominating the losers list. Trent, HCL Tech, Power Grid, NTPC, Shriram Finance, IndusInd Bank, Wipro. These are some of the other laggards. So yes, not looking good. We are continuing the sell-off. And whatever recovery or respite that we saw in the broader end of the markets, which by the way led the broader markets to outperform last week, has completely taken a U-turn, and now we are seeing deep cuts on the broader end of the markets, continuing from where we left off on Friday. Sudeep, looking at the open, first of all, any recommendations to navigate this market?
Looking at the open, at least I feel it's a pretty picture compared to what was expected around at pre-open 22,600. We were at least at that cusp of that breakdown, but yes, we still have a good 100 points to save. 22,550 is what I was referring to. So I feel yes, 22,550, 22,600 till the time the indices are holding it. And we try to recover back to 22,750. That is what would be an ideal scenario for the day. So yes, I feel 22,600, 22,550 still holding is giving some kind of hope. And if you see even post opening 22,700 put writers have also not seen much of a panic, or 22,600 puts are also witnessing some addition. Although there have been some call writing that is visible in 22,700 strikes, and that is given. Like we are seeing the gap down, so that's a given thing that 22,700 call writers would continue adding positions, but 22,600 put writers not yet unwinding. That is giving me some kind of a comfort that yes, this range still could hold out, and we could still see a range bound week or range bound a couple of days going ahead.
Okay, that's the view then. But any stock recommendations?
In the stocks, if you see, I feel one stock that is there on my radar is Indigo. And Indigo here, the stock has given a breakout on the weekly charts. 7-8 weeks consolidation has been broken. The prior trend has been positive since November 2023. In the last few months, we've seen some kind of volatile period, but the stock is still holding and it's close to its 52-week high by just 6, 7, 8%. So a lot of stocks, FNO stocks, have fallen more than 12 to 15% from their all-time highs, but this stock is now attempting a recovery. And I feel given the way the momentum is there in this counter, and with the crude prices weakening week over week, uh, at 45.20, 45.25, this could be bought with a stop loss at 44.50, and upside levels of 46.50, 46.80 could be witnessed here.
Okay, that's the view in Interglobe Aviation. That's a recommendation coming in from Sudeep. But Sudeep, a couple of counters I want to talk to you about. Of course, there will be changes to the Nifty 50 index. Zomato and Jio Financial will be replacing Britannia and BPCL with effect from the 28th of March. Now we know that the FMCG index has now, in fact, it's now losing for a 16th straight session on the trot. Your thoughts on the charts of a Britannia and Zomato? Zomato, of course, it has corrected quite a bit from its 52-week high, and last 3 months, if you see, the stock is down 15%. But over the last 1 month and the last 5 days, the stock has managed to give positive returns. So, any signs of recovery on Zomato? Do you think it will last? And secondly, your thoughts on the charts of Britannia?
And see, if you see firstly, let's just have a look at Nifty FMCG chart. Now, here, this index has given a breakdown of a consolidation zone, which was there in March 2024. There was a big support zone closer to 52,500 odd levels. And what has happened is, and that was the zone from where the entire rally up to September 2024 to the levels of 66,000 plus had happened. So now the entire rally has been fizzled out, and we are even seeing the FMCG index below the lows of March 2024. So that in a way is signaling some kind of a bearish sentiment for the FMCG index. And now coming to Nestle, right? Abhishek?
Britannia
Yeah,
and
Britannia.
Zomato.
So sorry. Yeah. So if you see the charts of Britannia, Britannia had seen a rally, say right from May 2024 till October, where it peaked out at 6,400. Here, that stock also is very close to its March April lows of last year. And I feel 4,700 here could be a important support. Now, if 4,700 is compromised on the downside, then the next level that could be witnessed would be 4,300, 4,350, which is closer to the 200-day moving average. So my sense is that the 4,700 should be a tight stop loss here, and below that 4,300 cannot be ruled out. And the next stock would be Jio. So here, Jio, I guess it's in a complete downtrend right now. Although in the last 1 week or so, the stock is trying to rebound or trying to form some kind of a base around 217 to 20 zone. But for me, I feel that 240 needs to cross, at least the 20-day moving average has to be crossed, which was broken on December 18th, 2024, below 337. So since then, the stock has seen a lower top, lower bottom formation, and any occasion it tried to breach the 20-day exponential moving average, it could not do so. And even on Friday also, it could not succeed crossing 239, which was the 200-day moving, 20-day exponential moving average. So here I feel, yes, while there's some kind of a bottoming out activity happening, crossover above 240 is essential for the stock for us to believe that yes, some kind of a bottom is being formed here.
Sure. I also want to get in your thoughts on Bharti Airtel. Of course, the company will be raising its stake in Airtel Africa by acquiring up to 5% stake. The stake will be bought in one or more tranches during FY25. Acquisition, of course, will be carried out through Airtel Africa Mauritius, that currently holds somewhere around 57.3% stake in Airtel Africa. I want to just pull up the charts of an Airtel. Telecom stocks in particular, given the texture of the rest of the market, do you think this is one pocket that will be largely, unaffected by what's happening globally? In terms of Bharti, it's holding on to that 1600 level. Do you expect, it to cross that 1650, 1700 level anytime soon, or do you think that will be a tall task for now?
No, I feel that it will be a tall task for now, given the way the selling pressure in the last 4 or 5 sessions that has happened. See, until last week or below, before the week of this first half of February, the stock was outperforming, and it was at the cusp of a breakout above its all-time high also, which was around 1779, which there of September 2024. But the last week's price action has seen some kind of a resistance being formed at higher levels, and I feel now 1690, 1700 zone will act as a resistance, and the stock will now be in a range between 1550 and 1700 on the upside. And I feel even if the stock does that, that would also be a positive, because given the way the other large caps or the other mid to large caps have been struggling, or they've seen some kind of a pressure from higher levels, a range bound move in the range of first say in the range of top 5 to 10% from the all time highs for a stock like Bharti Airtel would be a decent ask. So I feel 1580, 1550 on the downside, and 1690, 1700 on the upside. This stock could stay in this range and get confined here only.
Sure, that's the view on Bharti Airtel. And before we move on to queries, very quickly, I want to get your thoughts on a BSE. It has been included by the FTSE index as well after its semi-annual index review. But BSE saw good traction last week. How do you play this stock now?
See, in such markets, a stock staying closer, say 3 to 4% of its all-time highs, and every attempt of a recovery in the markets, the stock is seeing a strong pullback from lower levels. So for me, I feel it's important that this remains a portfolio stock, may not be just a trading bet as of now, because the markets are not conducive from a long side trades aggressively. So my sense is that overall 5450, 5500 will act as a strong support. The stock looks good for an upside, but yes, it could consolidate. And one should keep in mind that 5450, 5500 would act as a strong support on the downside.
Okay, those are the levels to watch out for on the downside on a BSE. But with that, quite a few queries coming in this morning. Let's get them addressed one by one and take as many as possible. Start with Satya. He wants to know your thoughts on Castrol. He has a short to medium term time horizon. Castrol is around that 450 level, has seen an okayish movement over the last 1 month. Off late, it has of course seen some bit of selling pressure. So with a short to medium term, would you advise taking a dip in this stock, or is it an avoid?
And I feel Castrol, if you see the charts here, the last 3 weeks has been good for the stock. Now, from the lower levels of 175, 180, the stock has moved all the way up to 214. And in a way, if you compare the mid cap index as well as the Nifty 200, Nifty 500 indices with the stock has outperformed by a margin. And the main reason for that outperformance was the strong results, the strong numbers that the stock had come out with. And that is the reason I feel from the current levels also 203, 205 remains an positional support, which should be which I feel will be an important level to watch out for. Until this 203, 205 support band holds, the stock could move up to 225, 230 on the upside. Intermediate resistance on the way could be closer to 218, 19, where the 200-day moving average is there. But overall, I feel the stock is well placed to move to 230, 235 on the upside.
Okay, 230 to 235 up on the upside. Those are the levels you can expect on a Castrol. Hope that answers your query. I spotted a query on an Ujjivan Small Finance Bank and IDFC Bank. Kishore wants to know which one, or in fact, are both the stocks okay for investment? Of course, for Ujjivan Small Finance, there is some bit of a news flow. The company's board has approved 364 crore rupee worth of NPA sale to an asset reconstruction company. The stock is in focus, but if you talk about IDFC and Ujjivan Small Finance, would you recommend taking an investment now?
No, I won't be recommending investing into this stock, not from an investment perspective, and even not from a trading perspective. So the stock, if you see here on the downside, before all the stocks started reversing, the stock itself was underperforming since January 2024. So lower top, lower bottoms, and even last 2 3 weeks, the stock has had a strong red candle, right from 40 up to this 31 32 mark. So I feel every rise here is being met with a selling pressure from higher levels, and until and unless this 36 37 zone is not crossed, lower levels of 23 25 could be witnessed and could be on the card. So it would be better that one shifts from the stock to a few large cap banks or even mid cap banks like Federal or City Union Bank also could be a good bet. But Ujjivan right now, Ujjivan SFB is into a downtrend and should be avoided.
Okay, that's the view then, Kishore. Hope that answers your query. The next one's coming in from Rupak Mehta. He wants to know if it's a good level to enter ITC or if there is any other FMCG stock to consider. I know we spoke about Britannia, but particularly for ITC, what are your thoughts? Because the stock, at least for today, it has edged back into the green. It's off opening lows and among the handful of gainers on the Nifty as we speak. Thoughts on where the stock is headed? It's now at 401. There was a time that the stock was stuck at that 400 level. Of course, it did break out and move above that 500 level, but of course, in the recent correction, it's back at 400. So, is it a good level now from an entry point perspective?
See, from an investment perspective, yes, this could be a good level. It is closer to the prior supports of April 2024, 380 and 410 band. So the stock is very well there in the same band. So yes, if you have a long-term view of 2 to 3 years, then this could be a good area to add, and dips also should be used to add. But if you're a trader, if the gentleman is a trader, then yes, I feel this is not a right level to enter long positions from a trading standpoint. As if you see the daily charts, weekly charts, last 3 weeks, the stock has been continuously trending on the downside. So although it might look like there's some kind of a buying from lower levels today, and the stock is in the green, but overall that could vanish any moment because of the kind of selling pressure that the stock is under in the last several weeks. So yes. Overall trading perspective, 412, 414 will be a resistance on the downside. 390 zone could be the support area. And investment perspective, this could be added at any point. Now, this I feel if someone wants to have a trading bet in FMCG space, then Tata Consumer is a decent play here because the stock right from January to mid-Feb was in an uptrend. Then we saw some kind of a corrective move or some kind of a profit booking from higher levels. There was a 38% retracement which got tested. So till 990 holds, there could be some kind of a reversal here onto the upside. And overall, we feel that this stock is better placed compared to all other FMCG counters where the index itself is at a several months low, while we've seen some kind of a reversal pattern which is forming in advance in Tata Consumer as compared to the FMCG index.
Okay, Tata Consumer from the FMCG pack looks good as a trading bet, and for a long-term perspective, ITC, you can in fact look at an investment. Let's move on to the next query then. Coming in from Debu K, he wants to know your thoughts on two stocks, Wipro to begin with, and IT pack of course is under pressure today. Your thoughts on Wipro in particular, and he also wants to know if it's a good time to invest in Kalyan Jewellers. The stock of course has seen a fair bit of drubbing. It has almost half from its 52-week highs. So would you look at Kalyan Jewellers now as an investment?
First, if you discuss about Nifty IT index, Wipro. So Nifty IT has given a breakdown below its November 2024 swing lows of 39,975. With the gap down today, it has even opened below the 200-day moving average, which in that sense it has not broken since May June 2024. So this is the first time after May 2024 that the 200 DMA has been violated. So that was the reason while in my opening commentary also I was mentioning that Nifty IT could have some kind of a pressure, and in case the markets have to reverse and we have to spot any reversal signs, then that could come from banking. Banking although is not supporting right now, But Bank Nifty would be our best case scenario if in case the markets have to reverse. So that index has to be closely watched. And Nifty IT, I feel, still could continue its trend on the downside, and one should not even bottom fish in even Wipro also. So leave the IT stocks at least for the next couple of days. Let some reversal pattern form here, and then we can once again reevaluate it.
Okay, his other query was Kalyan Jewellers. After a drubbing, the stock saw good traction or good recovery after its third quarter numbers. I think it staged a good recovery from January lows. But is this a good time to look at this stock from a long term perspective?
No, I would avoid, there's a lot of news flow surrounding this talk. So might be the numbers would be good, but yes, there are some news flows which are apart from the numbers which are doing the rounds. If we see the chatter, so there's something more which meets the eye. And here and even if you see the charts, the numbers were there in the last week of January, first week of February, and there we saw the stock move from 450 levels to almost 600, 595, 600 levels. And once again, the stock is corrected from those levels back to 480. So the impact of the numbers has been done away with, and now the selling pressure has resumed here. And 490, 495 will now act as a short-term resistance. And till the time 495 is not crossed, lower levels of 450, 445 could be witnessed. So my sense would be to avoid Kalyan Jewelers. If at all someone wants to be in this space, then Titan is a better bet. Although it's a say highly valued stock, but yes, the corporate governance, the way the company is being managed, and the volatility surrounding that company or any news flow, Titan in any day, in any given case, would be a better bet.
Okay, you can consider a Titan and avoid Kalyan Jewellers at the current juncture. That's the call. Last query then, Girish Lodha has a query on Religare. He's saying that in view of Burmans of Dabur now classified as promoters of the company, can it be accumulated at the current juncture? He's already holding 4,000 shares at the rate of 171.45. So he is making a profit here. Today, of course, Religare is down 5% after good gains last week. Would you advise him to accumulate now?
Yeah, if he's holding, he could continue holding the same quantity, and also accumulation also is not a issue here. 225, 230 zone could act as a strong support, and yes, the stock even in the last few weeks has been consolidating between 235 and 265. So I feel yes, at any dip here, this could be accumulated with 225 as a support zone on the downside, and about 255 to 57 the stock could rise away to 280 to 90 on the upside. So yes, this is better than all the other mid caps that we have discussed till now, and even if you look at other mid caps,
Right.
this is much better.
Sure, a good mid-cap pick here, Religare Enterprises. But, before I let you go, another stock that was in focus that I wanted to speak to you about, it's Healthcare Global. KKR will be acquiring controlling stake from CVC for $400 million, and it has triggered an open offer as well. The stake purchase will be at a price of 445 rupees per share, which implies a 11% discount to the Friday close price. Today, the stock is up somewhere around 2% or so, 510 or thereabouts. Any thoughts on how the charts are poised? 567 is the 52-week high. Would you expect retest of those levels on the higher side?
Yeah, yes. I feel given the way the stock is, the weekly structure of the stock is there, the stock has been taking support at all intermediate lows, which is closer to the say 100-day moving average always. So here I feel the once again this zone of 485, 490 will act as an important support until 485, 490 holds. The stock could rebound and continue its original. Long-term uptrend. So yes, at the current levels and also on dips, this could be added.
Sure, that's the view on Healthcare Global. With that, Sudeep would like to thank you for taking out time and joining in this Monday morning. Look forward to more interactions and of course more queries will be posed to you that keep coming in from our viewers. Thanks a lot and have a great day. Well, on that note, just look at the market. The sell-off has exacerbated. We have slipped below the 22,600 mark as well, very close to the support level that Sudeep mentioned. In fact, we are at 22,586 as we speak, and he had mentioned a floor of 22,580. Beyond that, of course, 22,550, 22,500. Those are the levels to watch out for. But yes, not a pretty picture when it comes to the screen. But on that note, let me bring on board our next guest for today. Joining me, Sunil Subramaniam, market expert. Sunil, hi. Lovely catching up again.
Hi,
Good
morning.
morning for sports lovers, but not such a great morning when it comes to the market. We are staring at a 200-point loss on the Nifty. The advanced decline ratio extremely weak, dismal, 1:6 NSE advanced decline ratio. Mid caps, whatever little recovery we've seen, completely fizzled out. How does one navigate? Because every day you wake up, you hope to God that today maybe a day of recovery, and those couple of days did come last week, but we've again reversed course. Your thoughts as to how much longer will this pain last from here?
So I think that, it's a very complicated scenario, and I'll explain why. It's that domestic institutions are actually sitting on a lot of cash. Okay, if you see the total mutual fund industry, I was looking at it, there's about 3.5 lakh crores of cash in the mutual fund industry. Of course, you got to take out the debt and liquid funds, but even I would say in the equities and hybrid side, you're sitting on over 2 lakh crores of cash. Now, what's happening is that obviously India as a market, because of the 2 consecutive earnings seasons not being great, is now being clearly seen as an overvalued market. And the correction that's happened, unfortunately, hasn't brought it down to yet a reasonable valuation. And the reason for that is domestic buying. See, when the FIs sold the large caps, they went and actually bought. So that's why you see the correction in the large caps is far less than the correction in the mid and small cap. So what's happening is that from a foreigner's perspective, India still remains a reasonably overvalued market. And so whatever little money is coming out of this whole Trump uncertainty into the emerging market is going into markets like China, where they already were very beaten down. And so the margin of safety is higher. That even if the Trump tariffs come in, they expect China to do some counters, so the market is trading at such a low that the downside risk is less. Whereas in India, you still have to wait. Maybe by this month end, you'll get the GDP number for the previous quarter, and that will show whether from the 5.4 we made a jump up or not. Because sequentially the earnings were better, but the market has yet to adjust itself to those earnings. They still expected higher earnings from this quarter, and they were disappointing. So I would say that this is a very interesting, because there is cash sitting on the sidelines. And there's an Alfred Tennyson poem, right? There's water everywhere, not a drop to drink. With such, SIP book is 26,000 crores for the mutual fund industry. The last month itself, around 40,000 crores of excess money, extra money came into the industry. But what's happening with the domestic fund managers? And today, I believe that this uncertainty till Mr. Trump's actions of how far he uses tariff as a threat versus an actual tariff implementation, what is the reciprocal tariff from 1st April, we'll get to know. So the uncertainty is likely to prevail, and FIs are unlikely to make a strong move back into India because those markets haven't corrected enough in the large cap space. Domestic fund managers, on the other hand, are picking selective large caps. So if you see now, FIs have been selling banks and financial institutions, but domestics have been buying. That's why in the 6-month fall, private sector banks, for example, have fallen the least. So fund managers are very selectively buying some companies where they see no tariff threats, and they see that the earnings season has been fairly decent and the outlook is fairly decent, which is true for the BFSI space. But in all of those spaces, domestic fund managers are also now hesitant to put, because, like I said, they were disappointed with the earnings season. And until a fresh direction comes, either on a stock-specific level where the numbers, the ground level sales numbers show themselves up for the running quarter well, and they'll be reinforced by this quarter's earnings season starting April, there's unlikely to be a very strong trigger. So domestic managers are doing extremely selective stock picking. In fact, they are booking profits on certain mid-cap and small cap where they feel that they've made a huge amount of money because of the rise, and the future outlook is not yet known. So I think the budget also, in that sense, because where they had stocked up, if you see the prices which ran up, was the public sector piece, the infra piece, and that's where they are actually selling now. So I'm saying that that's why I said it's a complicated thing, because domestic fund managers who can actually protect the market and take it higher are not doing it because the future is not yet clear. So I think one must be prepared for a reasonably extended period of volatility and uncertainty in the markets. I think the broader markets will continue to suffer a little more pain. But I would like to end on a positive note to say that I think we are nearer to the end now and we are closer to reaching a bottom. So I expect some amount of a recovery to start in the next few weeks and then gather momentum in the month of April.
Okay, positive note indeed. Bottom may in fact be in sight, maybe a couple of weeks when we could see some bit of a recovery. But you mentioned that private banks have seen the least or lesser correction. What are your thoughts on PSU banks? Today I was reading a note by Incred. They have in fact downgraded SBI and they are saying that return on asset may moderate as margins decline and credit costs normalize. In light of that, your thoughts on the entire PSU basket. Also, RBI has announced a $10 billion dollar rupee buy sell swap to inject longer duration liquidity. This comes after the last round of 5 billion, right? So, do you think this will effectively address the system liquidity issue?
So two things. Let me answer the first question first. So overall on the overall PSE pack, and then I'll come to the PS banks pack. PSE pack I still feel is overvalued, despite the fact that there's been so much correction in the PSE index. Considering that they're all railway, defense, a lot of those kind of stocks, I think there's still more pain there. So I would overall say that the PSE space is not yet an investable space from a valuation perspective. Coming to public sector banks, so I think that yes, to the extent that they are largely been non-retail players, historically. There have been people who have depended on CASA and have financed the corporate lending book. And as you know, over the last few years, corporate lending hasn't really picked up. And they have been entering the retail space. And I think the first steps there, the challenges at the very low end of the retail lending, right, are clearly now visible. What is seen in the small finance banks and the microfinance space and all of that is slowly creeping into this because these people didn't have a vast deal of experience in dealing with retail lending. That was a space where the private sector banks, the private sector NBFCs were the leaders there. So I think their models are very well established in the NBFC and the private bank space. The PSU banks, I think, are still trying to figure out what is the right way to assess risk in a large population when you lend with very less security and with not much control over the end use of funds. So I think those pain factors are being seen. But that being said, I think that the whole giveaway in the budget of the 100,000 crores, a portion of which moves to savings, I think will come into the CASA of the public sector banks. So I see that's one green light in the public sector banks. Second, I think this consumption is definitely going to be the space which is going to benefit from that giveaway. And as mass consumption goes up over the rest of the year, I would expect corporate lending to pick up because private capex, I say, is probably a 9-12 month away from picking up. And that's when the public sector banks will take a lead. So to me, if you're a medium-term investor in this space, then I would say every correction, you keep buying a little bit of public sector banks because ultimately when corporate lending picks up, right, they are going to be the leaders because that's the business they understand, they know very well, especially in the MSME space and where the NIMs are also very, very good because there's no pricing pressure is very less. So I would say that in the short run, if you have a 3, 6, 9 month view, public sector banks are probably going to see a little bit of a iffy run, but taking these corrections as a good pricier points to buy, I would say from a year and a half, 2 year perspective, you would probably be making a good deal of money if you keep accumulating them. So expect short-term volatility, but in the medium term, public sector banks should help out. So that this next question that you had was the injection of liquidity by RBI. Now I don't now say while there's a liquidity deficit and they're addressing it, remember that the liquidity deficit is caused by the RBI because of their action to support the rupee. So they are only redressing a gap they are creating. This liquidity gap has not come because of a domestic huge demand and no supply of money. It's being created by RBI and being set right by RBI. So it's just bringing it back to an even Steven. So while the injection is needed, it's preventing a short liquidity from hurting the system, but it's not something that the domestic liquidity shortage was created by credit deposit ratios going out of whack. And hence RBI is stepping in. So there are two clear reasons. RBI is just setting right what I wouldn't call it damage, but the impact of defending the rupee is being felt and they are just setting it right. So they're just bringing it back to even keel.
Got your point. Another thing that the RBI has proposed is to eliminate loan foreclosure charges and prepayment penalties. when it comes to NBFCs. How do you see this impacting the profitability and lending strategies for NBFCs? Could we expect a shift in pricing models such as higher processing fees to mitigate the impact on margins?
Yes, I think they will have to do that. I'll tell you why. Because essentially, the reason why a prepayment is charged is because there's an asset liability mismatch. Suppose you're borrowed long to lend long, and somebody is closing the loan, you have to unwind that long borrowing. And there will be a cost for unwinding the borrowing because based on how interest rates are moved, they will be having to take off that asset. So, from the fact that an asset liability management of the NBFC private sector bank had factored in a certain amount, and they were hoping that somebody pre-closes, the cost of their pre-closing their own long-term liability was going to be offset by a pre-closure charges. That if RBI implements this, then that goes away. So the three things. One, obviously, they will try to increase processing fees to make good the loss. Second is they will have to readjust the way they finance the book. So if, let's say, there's a 15-year loan, right? And then weighted average maturity of a 15-year home loan, let's say, is 7.5 years, just out of the blue, right? So at 7.5 years, they would have had a 7.5-year duration of their borrowing book. But now, factoring the fact that people will tend to prepay, they will have to shorten that period and make it 5 years. So they will run that risk. Those who manage it well can still get out. But it will change the way NBFCs and banks fund the loans. That is a longer term impact of this, which I think ultimately they are smart enough to manage and to do. But there will be a period of pain when they will not be able to receive any prepayment charges, but they will be still holding longer than needed liabilities on their books. So that's an adjustment period which we'll have to go through.
All right, that's well explained really, Sunil. Last couple of questions then. I want to talk about the auto pack, particularly M&M. Of course, this stock has seen a sizable correction. Today, of course, there's some bit of a green when it comes to M&M. But of course, there are concerns over Tesla's potential entry into India and with the new EV policy, which in fact may reduce import duty significantly. Do you think the valuations, at least for M&M and some of these Indian OEMs now capture the risks? And do you think Indian OEMs will actually see a significant impact of Tesla's India entry in the first place?
See, I think that there will be some impact. And the reason is that if you see in the auto space, the K-shaped recovery has been very clear, right? It's the high-end automobiles that are selling, not the low-end automobiles. And Tesla, if they come in, is going to be at the high end. Now, depending on the level of pricing that Tesla brings into the market, at the high end, obviously there will be challenges. And I think M&M and companies like M&M, like Tata's and others, who are making a big pitch into the EV space, might have to look at how they price their product. So there could be margin pressures more in anticipation, right? Now, the point is like this, in import duties are reduced even for the components, right? Part of it could benefit them because I think all these EV companies are still importing significant amount of the value chain from abroad. So there could be a benefit to them too. So overall, while I think it's good for the industry, individual players, I think, will definitely have to prepare their game plans. And unless there is clarity around this, the uncertainty will hit and the risk premium required of those stocks will naturally go up. So I think that's the pain you're seeing because it's still a gray area in what exactly form is Tesla going to come, how far they're going to indigenize their manufacture versus import from overseas and all of those pieces. So I think it's a wait and watch scenario, but definitely you can't say it's without impact because Tesla is a big player and it's an aspirational buy. So a lot of the high-end customers, right, would like to probably try it out. So you can't deny that.
Sure, taking your point then. Last question really, what are your thoughts on the QSR pack now within the consumption basket? The stocks have seen some good moves recent times. Of course, our outlook may be improving with tax cuts and easing food inflation as well, but numbers wise as well, on a sequential basis, Jubilant Food handed in a good quarter early report card. So would you, within the consumption basket, would you look at QSR now? Are the valuations looking attractive? Because they did see quite a bit of a correction, in recent times.
No, yes, I think QSR is the way to go. I think that those valuations, I think, yes, they're still a little bit rich, but I would say they're still a good bets to take because they are not in this whole tariff space, so that uncertainty will not prevail on them. The second aspect there is that they're not in the lending space where you're seeing some NPAs come and hurt. So they are out of that risk space, right? And essentially they are taking on the mass of the brick and mortar typical consumer pack. So from that point of view, I think that the growing younger demography of India, the access to the internet and all of those of which are India's success stories clearly plays out in the QSR space. And I think increasingly that's a space where you should probably not pick one or two players to bet on, but diversify across the whole QSR pack. Because it's hard to pick winners, because it's again a dog-eat-dog world. People will be going hammer and tongs at offering various freebies and this to gain share. You have the existing people also adding QSR to there. The existing consumer giants will add there. So it's a fastest growing space, I would say, in the country. And it's definitely good from an investment perspective to stay invested. But I would still say don't try to pick a winner. Try to diversify across the basket.
Okay, and one last question then really, if one wants to utilize the market correction to, look at themes that are a good, 3 to 5 year kind of a theme for wealth creation, or even 5 to 10 years for that matter, should one use this correction to get into those sectors, and would you be able to identify 2 or 3 such sectors?
So to me, I think the 3 sectors which from a 3 to 5 year perspective will do well are the BFSI space. And when I say BFSI, we did discuss PSU banks, we discussed private sector banks, but I'm not talking about the lending side alone. I'm talking about the savings and investment bank. So I think when you say BFSI, you're handling both sides of the balance sheet. They're less subject to tariff pressures. And I think as a growing economy, see, you say slow down, whatever it is, we are still at 6.5%, the fastest growing country by a couple of 100 basis points in the world. So I think we should not take our grounds for growth is there. And that will reflect in increasing jobs, increasing per capita income, and increasing savings and investments, as well as borrowing. So for me, the BFSI pack, despite the volatility we discussed on the PSBs, on everything else in the near term, is still a good accumulate on corrections pack over the next year with a 3 to 5 year outlook. That's my number one pick. The second would be consumer discretionary, because I see that, I think the monsoon is expected to be good this year. The early signs are positive. Rural demand should continue to pick up, and with the giveaways in the budget, I think urban demand should catch up. And I think discretionary consumption is where they will see the impact, because those are EMI driven consumptions where you can make that extra rupee go that much farther. So I believe that discretionary consumption is a good play again from a 3 to 5 year perspective. And with these two, right, for me, capital goods and infra as a space, building materials, capital goods, infra, EPC is now turning good, because it was excessively valued a few months ago. And I see a lot of pain happening in that sector. And that may continue for some time, but it's a good time to start gradually accumulating capital goods and infra, because ultimately this discretionary consumption piece is going to lead to capacity utilization going up in the country and private sector capital entry. It's hard to say when, but it's definitely going to happen over the medium term. So you can start buying slowly and gradually. I would say setting up a SIP or a STP into these 3 sectors over the next 12 months will give you very good value in a 3 to 5 year time frame. So to repeat again, BFSI, overall pack, consumer discretionary, and the overall capital goods space, do a gradual accumulation over the next year.
All right, got your point. In those 3 sectors, keep them on your radar. That's the advice coming in from Sunil. With that, Sunil, always appreciate chatting with you. It's very insightful, and your explanations are really simple, and they really help our viewers in understanding the current scenario. Thanks a lot, and I wish to communicate with you again on one of the shows in the coming days.
Sure. Thank you, and all the best.
Thank you. Well, with that, of course, looking at the market, 22,580, we are around that support level that was mentioned by Sudeep earlier on in the show. 200-point cut coming in on the Nifty. Broader markets, mid-cap index down 1.5%, advanced decline ratio 1:5. That's the NSE advanced decline ratio, so not looking pretty. But the number of gainers, thankfully, on the Nifty has increased, because at the start we just had 4 gainers, but now we have a good 10 or 11 gainers on the Nifty, which is being dominated by the likes of Dr. Reddy's, Sun Pharma, M&M, in fact, among the gainers today after being a big laggard last week. BPCL, Eicher Motors, Maruti, some of these auto names are also witnessing some bit of traction. But with that, we are completely timed out on this edition of Opening Bell. Thanks a lot for tuning in. Stay tuned to Money Control for all your other news and updates, and I'll catch you again at 3:30 p.m. on Closing Bell. Have a good day.